Yeah, you online for the workshop. Will be joining us in a minute or two. What's the matter, Sharon? There he is.
Hey, Bob.
Dan, how are you?
I'm good. Thank you.
Get on okay?
Yeah, no problem. Let's see.
You're gonna run your own slides, right?
Yeah,
Okay. If you like, I can do the first few,
sure. Let me,
about score and then just kind of the process roadmap, and then it's all yours.
okay. Let me, should I upload this thing now?
Yeah, and then let's go ahead and share it once you get it open. Make sure that's all okay. There you go.
Okay. Oh,
So now you just need to put it into slideshow mode.
see.
So down in the lower right-hand corner of your screen should be something that looks like a projection screen. If you click on that, it'll open it up as a slideshow.
Okay. One up practice session. Okay.
There you go. Beautiful. Okay. So we got 2 minutes.
Okay.
You good to try and get this done in an hour? Because
Yes.
people can
Yeah,
join for an hour and then they tend to jump off.
that's fine. Yep.
Okay. You do a great job. I love the way this presentation goes.
Oh, well, thanks. Okay.
All right. So I got 11:59. I'm going to hit the start button, and
Okay.
we can just watch people as they join in, and then I'll make an announcement or two, and then I'll get us started.
Okay.
Beautiful. Here we go. What happened to your slides, Dan?
Uh, see, uh,
Good afternoon, everybody. This is Bob Cohen from SCORE. Glad you're able to join us right now. We will get started in another minute or two. Dan, you may need to stop sharing and then do it again. There we go. You got it, and you got to just start your slideshow again. So some minor glitches, but we're there. I think we're in good shape. Um, Let me know, somebody just with a thumbs up or something in the chat that you can hear us and see us okay.
I don't win.
Great. Thank you.
Look up, baby. Come
Got some thumbs up. Good. Okay. Well, welcome everybody. We'll get started in about another, I don't know, 30, 40 seconds.
on, man. Come on, baby. Come on. Here we go, sweetie. Come on, man. Oh.
We got a cat. Yeah, my cat's downstairs. All right. All right. Let's get started. I got 12:01, and I am very pleased that you're able to join us and take your lunch hour with us. I think you'll find this workshop pretty instructive, especially if you have been part of the um, earlier Simple Steps programs. Hey, can you put in the chat if you've joined us for any of the other Simple Steps programs over the last few weeks? And that'd be excellent. Just so I know, we've got some people on here that have been through it. So again, my name is Bob Cohen. I am joined today by Dan Toll, and Dan is with SCORE as well, and is, as he'll tell you in a few minutes, has some fairly deep banking experience, and so I think that you'll find out that the things he's got to offer are going to be very helpful for you as you start your business journey. So, Dan, why don't you hit the next slide? And I'd just like to talk about SCORE for just a minute or two, and then we'll jump right into this. So SCORE has probably the largest network of free volunteer small business mentors in the country. We've got 240 chapters, just like the one we're speaking from here in Cleveland today, and some 10,000 volunteers that will help you with your businesses. So no matter what stage your business is in, we are here to help you start it, grow it, or transition it to something else. So, Dan, next slide. Our mission is basically very simple. It's foster vibrant small business communities through mentoring and education. Just like we're doing today. So you all know that small business drives the economy of the country. Probably at least 50% of it is based on small business. So, formation of businesses and job creation, wealth building is really important to us here in the U.S. to keep this economy running and running smoothly. So, as I said before, everybody in SCORE is a volunteer, everybody at our chapter, and we're very willing to give our time and energy and knowledge to help you start and grow your businesses. Next slide, Dan. We are here for everybody. If you go to our website, which I'll show you in just a moment, you can see areas that have some specialty areas as well that can help out. Dan, next slide. So this is SCORE in 2022. Of course, now we're at 2024. I think this is up here because we were chapter of the year that year. We're also regional chapter of the year for 2023 and 4. So we've really done a good job with our business. SCORE Cleveland is probably one of the just best chapters in all of the entire country. We run 7 counties along the lake, Cuyahoga through Cuyahoga, well, on the east side, Ashtabula, and on the west side, Erie County and Huron. So right across the lake. And as I said before, we've got some. Well, I didn't mention the number of volunteers. We've got about 100 volunteers here in the Cleveland area throughout this. Most of what we do is virtual, but we do a lot of in-person stuff as well. Dan, next slide. So our code of ethics is to protect all of your information. We cannot use any of your information for databases or any commercial reasons. SCORE members are not permitted in any way to make money or utilize anything within your business other than the advice that we give you. And every one of our mentors on an annual basis has to sign off on the code of ethics that for all intents and purposes is written here. Next slide, Dan. So I think I mentioned this, all of our services are free and they're unlimited. The SBA is one of our sponsors and we work closely with them. We're kind of a service partner with the SBA. We recommend people to them and vice versa. They bring us clients. Next slide. And I'm not going to go into the um, uh, our website right now, but what I would do is recommend that you go to score.org and then /Cleveland, and that'll get you here. If you do that, then you'll see that we've got a lot of incredibly good resources on this website. One of which is recorded workshops. We've got all of the recorded workshops, not only from the SCORE chapter here in Cleveland, but at a national level as well. And you can go on there and take a look. So no matter where you are within your business, there's a workshop. And we also work a lot with nonprofits. There's nonprofit workshops. There are templates, all kinds of valuable resources that you can use. If you're writing a business plan, there's templates for it. If you need financial templates, those are online. So Dan, next slide. So now I just want to talk a little bit about what we're about to do and where we've been in the past with simple steps. So simple steps one, if you hadn't joined us in the past, was just startup basics, what it takes to be in business, how to get yourself aligned. And the next session was basically how to articulate your business concept, where to find research about your business or your industry, your competitors. I delivered the marketing plan one, and we talked about a very specific case study with Ann's Nursery. We had a business plan outlined for Ann's Nursery, and we worked through that. And actually, in the first three sessions, the fourth session, we actually went into the kinds of accounting and things that you need in order to make your business successful. We define things like balance sheets and cash flow statements and profit and loss statements. And now, for the final last session, and we say the last to best, we're going to be talking the best to last, I should say. We're going to be talking about funding sources. So now, just want you to know is you listen to what Dan has to say, and if you've been to any of the previous sessions, you'll see that we are available as SCORE mentors to help you with any portions of your business planning and help you find funding. We are not funders, but we do work with many, many funders. And Dan's going to talk about the type of financing and funding that is available for your business. And it's a high level kind of informational process that he's going to go through. Again, if you need more detail, feel free to contact the SCORE mentor. And all you need to do is go to score.org, find a mentor, and we will get you somebody pretty quickly. So here's Dan. Dan, tell us a little bit about you, and let's move on.
Good afternoon, everyone. Again, my name is Dan Toll. I've been in banking for close to 30 years now. I've started lending to small businesses and then did large corporate lending, the Fortune 500 folks, and then been in most of my career in the middle market, which is basically everything in between. So you're talking about revenues of companies between 5 million and say $1 billion. And then over the last 4 years, recently concluding in May, I worked for the SBA directly started working on the Paycheck Protection Program, but was moved over to work on one of their two primary funding or guarantee programs. And so I was pleased because I was able to get direct experience. The SBA world, I knew of it, but I didn't know of it to a significant extent, and was actually able to work on processing loans and essentially making approval recommendations on loans for a bit with the SBA. So that has enabled me to speak with more confidence and more information with respect to startup financing because the SBA, as we'll discuss, is often involved in that process. I'm sorry. First, just going through the kind of the topics for today. Broadly speaking, I just want to give a couple slides each on what is equity funding. Sometimes folks, if you're completely new to this, and that's the basis from which I operate when I do this presentation, just to understand it, because people hear equity and they say, okay, well, maybe equity in my home, maybe that's something I know, or they'll think equities like stocks, publicly traded stocks. And I think I just give a little context to that. Then we'll talk about debt funding, which is what most of you will be seeking if you do indeed move forward and try to start a business. There's an array of different options out there. We'll focus mostly on obtaining loans from banks and credit unions, and talk a bit about what that loan approval process is, how your request is evaluated, and then I just conclude with a single slide of recommended steps in terms of things that you can do to help yourself prepare for the process and also vet your idea as the other simple step sessions have as well. Just a few more tips and that's it. Please bear with me. About 36 hours ago, I had no voice, so my voice is weak today. But the good news for that is I definitely won't run long on the presentation. Starting with equity, what is it? Initially it's the amount of money that you contribute to getting your business started. If you don't look beyond day one, you'll have what's called a starting balance sheet, and what that reflects on the asset side is money that you contributed to buy if you need equipment, if you need supplies, inventory, any manner of things that can be, but it's typically in that arena. That's your equity investment. You're spending it in the cost to get started, as well as any other cash that you might have on hand that you want to contribute to the business. So that's the initial tally for equity, and then over time it increases as you realize profits in your business. Equity goes up, and as you make additional investments, and then it decreases to the extent that you lose. If you have some quarters or years where you lose money, equity goes down. And if you pay dividends to yourself, which dividends are in addition to any monies that you might expense and pay to yourself as a salary or wages to employees, if you take out a dividend, that also reduces your equity as well. So it also, as I mentioned, includes contributions made in non-cash form. So if you contribute equipment that you already have, or you transfer real estate that you own into your corporate entity to be used going forward, that also constitutes equity. And the same goes for the broad category of furniture, fixtures, and equipment. The good point, generally speaking, the good point of aspect of equity is that if you bring in another party to join you as an equity holder, access to third-party equity beyond what you contribute. Obviously, that minimizes the amount of contribution that you have to make upfront. The downside of that is that that equity holder also gets a portion of the ownership of your company. And in general, I think it's fair to say that people would rather not give that away at the outset of their business and only would do so if it's absolutely necessary. So what are the types of equity sources generally? Again, anything that can, the first bullet point or the first category here, first couple categories here, really any form of asset that can be converted to cash to be used for a contribution, or any individuals with whom you have personal or professional relationships with who might be interested in investing in your venture, are potential sources of equity contributions. People can draw off their home equity loans. They can draw from savings accounts, loans against their 401k accounts if they have been working for a company and have had benefit previously. CVLI stands for the cash value of life insurance. If you have a life insurance policy, over time, there is a cash amount that builds up as that is invested, and the amount of that in support of that policy amount grows. You can draw against the cash value of life insurance. Friends and family, very common. One quick, well, I think friends and family are probably ideal on the equity side because they are most likely to align with your version of the business. So when you bring in third parties, you may do so on purpose because perhaps you want somebody who's experienced in the business that you're going into or has professional experience in a type of, in a particular category, finance, operations, whatever it might be, that will help you get your business off the ground. But the downside is that they also have a say in how things are done. It may or may not be a downside for you, but it is something to consider. Crowdfunding is something that's come into existence over the last 10 to 15 years, where basically platforms are set up where on one side, the suppliers of the equity and debt, as we'll see, are people like you and me. It's people that I'm signed up to multiple crowdfunding sites at this point, just informationally to see the kinds of businesses that are getting funded and how they're getting funded. But crowdfunding was created as a way of sort of democratizing access to equity investments for non-rich people. I guess to be blunt, it's a way to invest amounts as little as $500 or $1,000, which, depending on your personal perspective, may not be little, but relative to investing $1 million or more to get into a particular kind of business, it allows people to get a share of a business that they're interested in supporting, whether it's because of the purpose of what they do, or just looking for a financial return. Those platforms have been growing in popularity. They're actually regulated now to make sure that investors and the businesses that obtain funds via those platforms are protected. So it's an option. I don't see it either for debt or equity very often, but it is definitely something that startups can try to access. I mean, essentially, you don't want to cut off any possibilities out of the gate when you're starting up. So, and in that spirit, I'm also just going to mention venture capital and so-called angel investors. They are typically not investors in the types of businesses that we at SCORE often see started. And in number, the number of businesses that are started in the United States that are supported by the SBA and other sources are largely what we call Main Street businesses. Plumbers, retail stores, maybe hotels, small hotels, or any restaurants, those kinds of businesses that are not, when you think about venture capital and angel investing, think about high-tech startups like Amazon, or I mean, pick your favorite. I mean, these high-tech companies that, or life science companies often too, that have an ability that investors believe have an ability to scale up rapidly in terms of revenues over a very short period of time, and often end up by providing their investors with a return by going public in the public stock markets. But I'm just mentioning them because you might see those references, see a reference to venture capital out there. That's typically not the kind of capital that's going to be available to the average small business starting up. But again, it's there. Debt. When we talk about debt, one important concept to grasp is that and debt involves, again, it can involve friends and family, but often it involves third parties in various forms. But when when you're starting up, everybody typically thinks of getting a bank loan. And I understand that. Bank loans are, it's a natural inclination to think, oh, I'm going to go to my neighborhood bank and try to get a loan. The reality is that bank financing might not be available to all startups when they begin, simply because the risk may be greater than, for example, a bank is willing to undertake, or it's a different kind of concept than traditional banking sources, traditional funding sources like to take. So you really need to be source agnostic when you start out. And we'll get into these other kinds of, they're not necessarily non-traditional, they're sources that you'll recognize, but they're not bank loans. And the reason is it depends on every situation. And that's why I say no one source at the start is any better than another, whether it's credit cards, online loans. I mean, it's really a function of what your resources are and what the circumstances are, what type of business you have, et cetera, are at the time when you start. So for example, if you see a credit card and say, okay, that's going to charge me 30% interest or higher, actually. So people look at that and go, oh my gosh, I don't want to do that. But think about this fact. Think about if you can't get a bank loan because nobody's willing to buy into your concept yet. If paying 30% for 1 or 2 months will get a critical mass of customers on board, it may very well be worth it, because no matter what your business plan is, once you start on day one, you can have all the information you want, but then it's time to get them in the door. Because whether it's a credit card, whether it's a loan, you got to pay somebody else in 30 days. So it may be worth it to you, whatever the cost, to get your business started just because you want to get it started, but also to get those customers in the door. And then that permits, generally speaking, access to lower cost sources of funding going forward. Second concept here deals with information. Price flexibility, loan terms, that structure flexibility and loan terms vary with the level of knowledge that is obtained by the borrower about the funding source. So what does this mean? Okay, well, here I'll just say, as a lender's knowledge of a borrower increases, the latter's loan terms improve. Here's why. Let's use credit cards as an example. So I get a business credit card. It's going to require you probably to guarantee it, may even ask for some collateral, but it's for sure going to have a very high interest rate. Well, why is that? Well, because when you fill out a credit card application, they're not asking for a lot of information. They're going to look at your personal credit scores. Everybody's going to look at your personal credit scores, except maybe friends or family, frankly. So just be prepared for that. But they're not asking for much. They might say, well, what's your business in? How are you going to use the money? They might even ask that. And so because they're getting that little of an information, they're going to charge a high interest rate to compensate, because they're getting such little information that they really don't know much about they're not asking a lot of questions about the odds of success for your business. They're just willing, and one of the reasons that they charge that much is because they aren't asking for that information. Credit cards play a volume game. They bank on the fact, literally, that they understand that a higher percentage of their customers are going to default, and that's true personally as well. They understand a higher percentage are going to default because they're not asking for as much information. And that's why they charge high interest rates to compensate for that, because they know they're going to end up writing off a fair amount, depending on the credit card and the criteria that they use. Whereas, take a bank loan, for example. They're going to ask for a business plan, which is a whole lot of information about your business. And yes, they will look for credit scores and other metrics about what you bring to the table personally, because, and the reason why they're going to ask about your personal financial situation a lot is because, again, you can have the business plan, you can have the greatest plan ever, but until it's proven out, it's still a risk. So when you start day one, your personal financial wherewithal is basically indivisible from the company's until you start bringing in customers. So that's important. The bank's going to ask a lot more information. Get a business plan. They're going to take collateral for sure. They're probably going to have some covenants or some minimum requirements of performance on the on their loan structure. They do all this because covenants are, for example, are going to hold you to a standard of performance based on your forecast. Okay, credit cards don't care about that. Again, okay, here's the money. Go. We pay the minimum by each month at this interest rate. Banks will give you a lower, generally give you a lower, well, certainly less than 30%, because they know more about you. They'll get to know more about you personally. They'll know much more about your business than other sources will. And it's that informational content that allows them to lend at a lower rate. And that's something I learned a long time ago in business school. I took a class in bank management, and that was one of the biggest takeaways. Is the biggest value that a bank has, apart from its assets, but really its biggest asset is an intangible. It's information about their customers. Because every time a business goes somewhere else, they have to recreate that informational relationship. You got to tell your story again. Somebody else has to get to know you. So it's an important concept in multiple ways, but in terms of seeking financing, that's why banks are going to be lending at, say, 8 to 10% right now, and there are outliers on both sides, but that's why that's different. Generally, people will look to get obtain debt because, as opposed to equity, where if I have a 50-50 equity partner, my partner's entitled to 50% of the profits and 50% of the value of the sale of the business if we decide to sell it. Debts, a lender's return of any kind is fixed. Whether it's 30% or 10%, it's fixed. That's all they get. And that's another reason why they'll take collateral. They'll want personal guarantees because they're taking a large amount of risk in the case of startups for a limited return relative to that risk. So it's you also don't have to, as the last point here, you also don't have to surrender any ownership. So that's why it's generally a good idea to look at debt first. And the key with debt, and I need to add a bullet or another section for this, but the key is balance with debt. It's optimal to take as much debt as you can without risking financial distress. Okay? And that's a very fine line. It's never going to be an exact line, certainly not for a startup, because your projected financial performance is just that. Everyone knows, the lender knows that it's an important exercise to go through because it gives you something to manage to, but first and foremost, you're making the assumptions going into the forecast, but it holds you to, and the lender to sort of a certain expectation, but every lender knows that it's not going to go exactly like that. unless your business is based on contracts. If you have contracts with the government that have a fixed pay component for X number of months or years going forward, then you can feel really fairly confident that that component of your revenue stream is going to occur as expected. Debt source types, again, credit cards, online lenders. Here are a few. I suggest that you go on and check these sites out. As I mentioned, they will be higher cost because they will be asking fewer questions. They tend to be a little bit less higher cost than credit cards, but their repayment requirements may be more stringent, meaning daily, even weekly, daily repayments, because they are charging less, but they're trying to mitigate their risk in ways, for example, that credit cards don't, by getting faster repayments than you would have otherwise. And again, you may be very well willing to live with that if the amount that you get can allow you to get your first couple of customers in the door. That means everything. And there are also lender marketplaces. Go to Lendio, for example. Lendio has agreements with about 65 different lenders, so that when you go on, you ask with these online lenders, or whether it's a marketplace, what kind of information do they ask for? It's still fairly basic. Some may not lend to startups. It's just the way they work. Others do. So they'll probably either ask or pull. I don't know whether it's a soft or hard pull on the credit score. They'll ask what you're going to use the money for, what type of business it is, but not much more than that. I mean, you can fairly easily apply for these. But again, if it's a marketplace, you may get, lenders may come back, those who are interested will come back with essentially what is a term sheet, the terms upon which they are willing to lend. They will typically be different. And these marketplaces offer counselors or advisors to talk with if you want to talk through what those options look like and understand them thoroughly. Obviously, the same thing is true with the online lenders. You want to make sure that you're seeing all the fine print. Okay, make sure you see it. It's a good opportunity to call somebody from SCORE if you access those sources, just to make sure you're fully understanding what the conditions are. We talked about crowdfunding. It's the same concept. Honeycomb is based here actually in Pittsburgh. It's a popular crowdfunding site. I don't want to get into it a lot, but basically what they ask for is, if I want to try to raise $250,000, I'm going to cite why, what is it I'm looking for. It's almost like you put a pitch of your business. It tends to be, sometimes it's a full business plan, but most often it's a shorter version of your business plan. It's a kind of a pitch template, which you'll include a financial forecast. And what happens is you run what's called a campaign. So for your campaign typically lasts for 60 days. So you'll get your information on there. And as I say, it is now regulated. So it'll actually be in the form of what's called an offering memorandum, which is what large companies do. For example, Coca-Cola, when they're offering debt, usually to institutional investors, but they prepare what's called an offering memorandum. So it'll have information about your business, but then it'll have a lot of legalities that talk about, the risks that are involved, et cetera, et cetera. But once you get that set up, and there's people on those sites that will help you get that set up, your campaign starts. So you may say that the minimum increment of investment for my $250,000 is $1,000 or $250. It just depends what you want to do. And I think they have some, I will say the crowdfunding sites, certainly on the debt side, tend to have some input on your terms, which I find a little bit less favorable. But if it gets you access, it gets you access, meaning that they might have something to say about the interest rate, for example, if you're doing debt. But basically, you go for 60 days. And interested people, like I say, people like me that sign up on the site, and are willing to invest maybe $500 in something or whatever the amount may be, they'll ask you questions. They have the ability to ask you questions about your project, and after 60 days, you're done. So if I've obtained 150 of 250, I'm done. And then there's a little interim period, and then you start on the clock in terms of having to repay if it's 250 investors or 25 investors, however many people it is. And obviously that investor base individually can get quite large with crowdfunding. You have to make payments. And I think you make the payments to the site and then they distribute that. But it's an option, so please explore it. My next line here is basically the first two, invoice financing and factoring, relate to higher cost forms of financing when you can't get a conventional line of credit or something to help you at the start. Equipment leasing is something you can do up front. The benefit is fairly obvious. You don't have to buy it. You're not putting 100% of the cost out the door when you buy a piece of equipment. And there are so-called micro lessors that will do micro leases these days, meaning they can be $2,500. I mean, the so-called capital markets, the array of people and institutions that are out there, I mean, it just continues to grow every year. And, so which is good. It's very good for the entrepreneurial ecosystem because it's more chances for you to find a match for what you need when you get started or early on before you're able to transfer into a more conventional banking relationship. So equipment leasing is something to consider. If you have choice between renting a facility and buying it, I would never buy it to start unless your business is it has such specific requirements with respect to, say, leasehold improvements, where you need to modify the space so much that a landlord wouldn't allow you to do it. So, for example, if you want to turn a warehouse into a bowling alley, that's typically not something that a landlord's going to allow. Not, there might be a special purpose investor or owner of that building that's okay with it, but it limits your financing sources because if a bank or someone else has to take back a bowling alley, they have to invest a lot of money to convert that back to a warehouse space. So lease if possible, because it gives you, being able to, as opposed to 100% up front, to being able to lease for 3, 5, maybe 7 years, but typically 3 to 5. I mean, IT equipment, there's all kinds of things you can lease these days. So I would suggest exploring that. Other types of well, I can talk about factoring and invoice financing very quickly. Factoring is when you have a receivable, and typically when B2B type businesses, you may not get paid. The traditional terms are 30 days. So what you do is a factor will come in and buy what that's called a receivable. They'll buy that receivable and give you a haircut on it because they're going to assume the risk of collecting it at that point. So you may get 80% of what your invoice is to them. But again, it's worth it to keep the cash coming in. Cash is king. I mean, never more so than at the startup. Liquidity. So invoice financing is very similar. That allows you to get money. You provide you get an invoice. Somebody orders something from you. This is typically more applicable to manufacturing businesses, and it allows you to give you some money to build that inventory and then sell it to them. Again, it's in the name of when you are finding sources to keep as much cash in the business as possible and having the least amount of cash go out as possible. There are mission-oriented and community development-focused institutions. One that I'm going to note here in particular is ECDI. And ECDI is based in Columbus, but they also have offices in Cleveland and Cincinnati. And I've worked with some folks there directly. I highly recommend reaching out to those folks at the outset of any any startup type of financing. They they are authorized lenders for certain SBA programs, but also they have relationships with a bunch of different banks that will, for example, participate. They can participate out to invest in your loan. So it's a way for the banks who are participating to minimize their risk, but also satisfy Community Reinvestment Act requirements. I highly recommend it because a lot of the people on staff there have come from banks, come from community banks. I talked to one person there with a SCORE client, and he was just rattling off different types of options. Very knowledgeable, certainly more knowledgeable than I am about the different types of financing that are out there. Let's see. So we talked about friends and family. Your traditional, the most traditional way or the traditional type that a startup aims for is bank or credit union financing. Okay, so that comprises, that environment or ecosystem consists of the large banks. So think like Key Bank, Huntington Bank, Wells Fargo, Bank of America, JP Morgan Chase, those types of banks. Fifth Third, again, US Bank. And those are the big banks, the community banks, First Federal, Lakewood, for example. They're scattered all around. And credit unions, there's credit unions that I've become familiar with. There's a credit union in Lorain County that's a supporter of SCORE, and a woman there that I know makes presentations about becoming bankable periodically. So I always recommend when approaching banks, pick them out of each category. You never want to just approach one financing source at a time, because that invests your time. And if it takes 2 weeks, sometimes 3 weeks, which is not optimal, but for someone to get back once you've submitted an application, that's time, and time is money. It's opportunity cost. It's the time when you could be getting a customer, you could be going to market. So invest your time across all of these, because, and also numbers, and amplify your option of getting funded. You hear a lot about SBA financing, and I just want to explain sort of very quickly what SBA financing is, because you often see, oh, it's SBA financing. What that means actually is the SBA is guaranteeing a portion of a loan that a bank or credit union is providing. The SBA is not a direct lender. It facilitates, it empowers economic growth, job growth, company growth by providing guarantees of percentage guarantees of principal amounts that banks lend. What does that mean? Depending on the program, that can be anywhere from 50 to 90% of the loan amount. And so how does that come into play with startups? Well, in a startup situation, it allows the bank to essentially lay off 50% of their risk, and the SBA is willing to step up, because if it's to a startup, for example, or any existing small business, it fulfills their mission. That's why they'll step up. And for a bank, it's like, okay, I've only got 50% of my loan at risk here, my principal amount at risk, plus I'm reinvesting in the community and empowering entrepreneurs as the regulators want to see me doing. So it's a kind of a win-win scenario there. There are different SBA guarantee programs. 7A is the largest. I worked on their 504 program, which is more specifically financing, refinancing, also some business acquisitions that are real estate, commercial real estate, and equipment oriented. SBA.gov is your friend. Check it out. You can very quickly see what types of programs are available under 7A, also under 504. So I'm not going to go into that a lot there. The key to access, so people say, well, why isn't every bank using, or every company using SBA financing? That's because it has to meet what's called the no credit elsewhere test. A bank and essentially gets permission to utilize SBA financing when it can demonstrate that this company can't get credit on sort of market terms, the terms that would be, relatively, normally available in the marketplace for businesses. So, whatever that form takes. In startups, the nice thing is if you're starting up a business, you pass the test every time. Startup has sufficient risk. I mean, that's the good news, bad news. I mean, you get access to SBA-backed SBA guaranteed funding because you're a higher risk as a startup. But I think you know that going in. So let's go through the approval process. I tend to go through the back half of this a little faster. Again, business plan, tax returns, financial projections, sources and uses. That's very important. It's absolutely, and it's required if you're doing SBA-backed loans. The SBA will want to see a very specific use backed up by receipts and/or invoices of if you're going to use it to buy this equipment, they're going to want to see each piece and have that detailed. So if you start buying equipment on your own in advance of getting a loan, make sure you're literally keeping the receipts, invoices, whatever they are, because they will not only demonstrate the sources and uses of how you're using your funding, they're evidence of your equity contribution. Okay, so that's very important. And again, as I think Simple Steps has talked about throughout the series here, it's important to emphasize empirical data in building arguments for your idea. If you build it, they will come will not be sufficient. You need to look at, and there's a plethora of data sources out there, whether it's census data, Cleveland Public Library, Cuyahoga County Public Libraries. Those are excellent sources of information for this type of, if you're trying to put teeth behind, if you say your target demographic is people aged 30 to 45 with middle income, middle of the road income streams in Akron and the surrounding suburbs, you can actually come up with that number based on if you do research on each of those municipalities, get the demographic data, and that's what constitutes your total addressable market, which is an important concept for both you and the people that are contemplating making an investment in your business. So at that point, identify lenders, as I mentioned, try to hit multiple. Always try to set up a meeting. And this is where community banks and credit unions come in for me. With the larger banks, that's become less feasible. Reason being cost efficiency. Over time, the bank branch continues to shrink. Why? Because 50% of people in the United States now do their banking on mobile phones. So there is not as much, there's not as much of a need for, when I started, I was a commercial banker on a retail floor in a community bank, okay? Or it was actually a division of a larger bank. But anyway, that's the way it used to be. If you walked into excuse me, my cat remains, or another cat remains interested in this process. If you were to walk into a bank 30 years ago, you'd be able to see retail bankers and commercial bankers that you could just sit down and talk to if they were available. That's no longer true. If you go to Huntington, and this is not a knock against Huntington, if you go to Huntington, they may have, or Fifth Third, where I bank here locally, they're going to have maybe one person in an office besides the teller. And what they do is they serve as conduits. So for Huntington, for example, which is a top 10 nationally SBA-backed lender, it'll be the branch manager that takes your application and forwards it into for an SBA department to then evaluate and what's called underwrite your loan. But you'll get contacted by those folks, but you won't be able to sit down face to face. Community banks and credit unions, you have a much higher chance of doing that. I always recommend that. I think it benefits both parties. As a, I was a credit officer for many years. Um, I don't do credit approvals from behind a desk. I get out and meet people. And because another thing that's a truism when you start a business, we talked about how financially you personally are indivisible from the business. Well, the business itself is you when it starts, right? I mean, you're always going to be a part of that, but maybe you grow and add further. But I would want to meet the person that who is going to, I'm relying upon to repay my loan. And conversely, you'd like to meet the person that's going to be looking at your loan and potentially, if you get approved, managing your relationship going forward. It's a mutually beneficial situation. So I always advocate trying to do that if you can. You, again, not a pitch for SCORE, but if you talk to someone like me, or I know other people in SCORE, I mean, I can make recommendations for people, and we're required to make at least 3 of people that you can go sit down with. And happy to do that, happy to make those recommendations. I think and then again, it's not to diminish the big banks, because the big banks do a lot of this, and they are usually what are called preferred lenders with the SBA, meaning that they get to make the decision on behalf of the SBA. So there's one less. It's not a 2-step approval. It's just like a bank loan. They're allowed to approve on behalf of the SBA because they're large and they've done a lot of it, SBA lending. They can approve on the SBA's behalf. And and they just report the loan to the SBA. So you're still meeting or giving it to a decision maker. So you should do it because, Huntington is very, as it should be, is very proud of its status as a top 10 SBA lender. Key is up there too. I mean, Huntington's not a hometown bank, but essentially it is in terms of its size. It's based in Columbus, but Key, Huntington, some of these other, whichever institutions you want to look at, but on the large size, it's still worth it. But also visit the smaller folks so you get that face to face, and you're able to make your case face to face, and they're able to get a read on you, and you can ask them questions too. Like in the last section here, ask them about how they're organized. Ask them about the approval process. What's the timing going to be? Who's involved? Okay. Ask those questions, because it also shows, it helps flesh out your credibility that you're that interested in the approval process. I mean, it's not sort of, okay, here's my pitch, bye. I'm serious. I want to know what's involved here. I want to hold you to a timeline. Okay. When they ask questions in those meetings, don't sugarcoat the risks. They'll know, for one thing. They're going to have an idea. Experienced lenders are going to know, have a good idea when you presenting your business or submitting a business plan for your business. They're going to generally know, maybe not every risk, but most of the risks that are associated with that. First and foremost, startup risk. You have no customers when you start compared to existing businesses. So don't sugarcoat those risks. Embrace them. Say, yep, I know. And think about it in terms of day one, what's going to keep you up most at night? And it's probably going to be customer generation. So the primary thing they're going to be asking about, okay, I see the expense side, I see the cost side. How are you going to generate revenue? And so don't sugarcoat it. And it's okay to say, I don't know. It's not a failing. It actually enhances your credibility, because bankers don't know everything. I don't know everything about a particular situation. It's okay to say that. Just say, yeah, I'll get back. Can I get back to you on that in 24, 48 hours? They don't expect you to know everything. So that's important. Approval process is simple. There'll be a couple folks looking at your deal, at your loan, and they'll spread your projections on their own system so they can look at ratios that they like to look at. They're going to review your information, see if they need to do anything on their own as far as research goes. And then they'll prepare a credit memo, which is in many forms a reformulation of your business plan. A lot of the same information, but the added portion of that from their standpoint is a constant focus on risk and mitigants. That's essentially what a credit memo is all about. What are the key risks? How are they mitigated? By things that are provided in your business plan or things that a lender might already know from previous experience. The process, it can be either loan via signature authority. If they say they use signature authority, that means one person is signing off on it. If it's a committee, that means it's a loan committee that meets maybe a couple of times a week, and there's 4 or 5 people looking at it. There's pluses and minuses to both, but either way, it doesn't there's nothing that adversely affects, proportionally greater adversely affects your application, depending on what type it is. They'll come back to you. They'll communicate if there's any changes that they have, or if they're, what the outcome is, how they would like to see the loan be proposed, if they have any additional questions, which sometimes happens. If you get a yes, great. They do their due diligence. You review the credit agreement, and you're off. If you don't get approved, which happens, don't just say, shucks, and walk away from it. Ask why. It's very important. It'll help you to know not only for that moment, but also going forward, how lenders are going to may look at your business, what they see as the hot points. Okay. Very important thing here, because people there's a certain degree of fear that exists in the small business community about going to banks and how do I get approved and this and that. I just said it. That's it. A couple people help prepare the credit memo, including one that you met with, if it's in the smaller bank, and then it goes, and either one individual or a few individuals look at it and say yes or no based upon how they perceive the risks versus the mitigants. How it's evaluated, very quickly, 5 C's of credit. Personal and business credit history. Character is personal and credit business history, how you've handled your obligations in the past. Professional experience, references, if they ask for any references regarding you. But it's really how have you handled your obligations in the past. It can also, again, refer to your resume, which is going to be very important in your resume, which people often provide in the business plan for startups, and I recommend it because your experience, again, you are the key factor behind your business succeeding at the outset. Capital, that's equity, right? It's the stuff we've talked about. It's the amount of debt versus equity in the business, and also what your plan is for earnings retention, meaning that, just quickly, lenders aren't going to get terribly excited if the first thing in the first 3 months of you starting your business, you want to start paying yourself dividends too. Okay, they don't want to see any money coming out of the business early on in your early goings on. So they want to see that money retained and reinvested. So just understand that it's okay to pay yourself once you get started a reasonable amount that still allows you to make a profit, but don't look too quickly to start using your business as a piggy bank. Capacity, this refers to, and this is the key. This is it. This is what the SBA focuses on. The ability of your projected or actual cash flow to cover debt service requirements. That's it. It's the key metric for the SBA that the SBA looks at by far. There are other important things depending upon the circumstance, but that's the key. So what am I talking about? An ability to cover your projected cash flow to cover your debt requirements by a margin, not just 1-to-1, where you're sort of just breaking even. Let's say 1.2-to-1. Okay, that's what they're looking for. And it does not mean that you create your projections to indicate that. Okay, you got to be honest, because it's important for yourself to know. You're not just selling third parties. You need to have the conviction that you can meet with a 1.2 coverage time. That's very important. A lot of this process is for you as much as it is for third parties. Collateral, they're going to take a security interest in your assets, whatever they are. Sometimes they might want a second if you own a home on your home equity. Just be prepared for that. And of course, you are going to guarantee, just know that coming in, they're going to have a personal guarantee from you. Um, Conditions are just what the terms and conditions are of the loan. Again, the various forms that that can take. And it can also refer to the industry conditions, how competitive, is it a low margin business where cost is everything, that type of thing. So just to want to conclude real quickly here with just recommended steps, you know, when if you're currently working and thinking about starting a business down the line, um, number one, try to get experience if possible, even in a side job. Um, Getting experience in the business in whatever capacity in the business you're going to start. Okay, there's nothing like having some hands-on experience. And I mean, if you want to start a restaurant, that means being a waiter or a bartender, because you get to see more than just what you're doing by working there. Eventually, you get an avenue into how the place works. There's more than you can get a lot more from what your specific position entails. Always building, maintaining personal credit score. I don't think that's going to come as a shock. Um, Score website has lots of resources on that. You can talk to us about it. There are certain things you can do, but mostly it's just the nuts and bolts of trying to make your payments to the best of your ability on your required obligations. Grow your network, whatever that is. Volunteering, work, attending events. Industry associations will often have events. If it's an industry that you're looking to get into, great place to go to make contacts and get information from people who have already done it. LinkedIn is another way not only to market your business, but learn about people who are already there and make contact with them. Research, research, research. You can't get away from it when you're starting a business. Whether it's the marketing piece that Bob did, in the simple steps, you see it's all, the foundation is research, okay? Tri-C, libraries, industry publications, AI. We are increasingly using AI as a tool at SCORE. We can talk to you about how to use ChatGPT, which is when you see generative AI, that's what that means. It's generating data results from an inquiry. So AI at this level is all about how you pose your inquiry, your question of AI in terms of the results that you get back. IBIS are industry profiles. Esri is a database service that you can access through the library to help with demographic data. And then, of course, whatever form it takes, grow your knowledge base in areas pertinent to your business. Because at the end of the day, it is going to be harder for you to go from, if I wanted to go from banker to baker, that's a harder transition for me. That's a harder sell for me to make to a lender, okay? So if I can't make that, I haven't been able to work in it, but I've always wanted to do it. It's incumbent upon me to say, I know I haven't done this before, but here's why I think I can do it. I've been cooking whatever it is that's related to the restaurant or your bakery for 30 years. I love doing it. I do it all the time. I've talked with bakers. I've sat in and just sort of watched a day in the prep of a baker or whatever it is, whatever you're going to need to do to help persuade them. Okay. And lastly, I would recommend when you start growing your knowledge base, just in general, if you want to be in business, getting familiar with accounting is going to be important. Bob at the outset referenced that with session 4 of Simple Steps. It's important so that you can speak the language, okay? It's not overly critical, and we can teach you a lot about what you need to get started, but it's an important language to learn. I think from a third-party view, you look at it, if you're not familiar, it's like, oh my God, accounting, everybody kind of rolls their eyes like it's boring and everything else. I actually loved it. I ended up majoring. It was one of my majors in business school. I had never had any exposure to it. It's logical. It makes sense. You might be surprised. You might actually kind of get into it. It might actually result in a business opportunity for you. So I do recommend that. And it's 1:03, so I'm 3 minutes over, but I still have my voice. So partial mission accomplished here.
Hey, thanks,
Bob,
Dan.
I have concluded.
Appreciate it. Good timing on
Bob
that.
here?
Yeah. Can you hear me? Yeah, can you hear me, Dan? Can anybody hear me? Um, anyway, it looks like we're done. Uh,
Oh, Bob, did my volume go off?
maybe, maybe. Yeah, so everybody can hear us. Listen, everybody, thank you for joining us. Thanks for spending your lunch hour with us. Dan, you did a great job as always. I think that the information Dan gave you is critical for you to explore and grow your business with. So feel free at any given time to contact us if you've got any questions. Happy to help you. So everybody have a great rest of your afternoon, and we will talk in the next